This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. The Wealth Roundup for the week of January 7th, 2026. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Happy New Year, Patrick.
Yeah, it's great to see you, Terry. I had a great holiday. I hope you and yours did too.
Yeah, it was terrific. Missed my son on actual Christmas Day. He didn't arrive back from India until New Year's Eve, but we had a good after New Year's Christmas with him and his girlfriend. It was kind of nice. It's been an eventful start to the new year with the first full week. We're getting into it with both feet. There was some business in Venezuela. How much did that affect the markets, if at all, this week?
I think specifically with the oil markets, there definitely was a pickup in volatility. I suspect that there will be some longer term impacts depending on how this unfolds. I think initially, we saw West Texas Intermediate prices drop. They were lower anyway. So, oil prices weren't going into 2026 strong, but largely have kind of stabilized since the weekend. Like I was looking at Western Canadian Select today, and it's at the same level it was 30 days ago. Kind of longer term, we had Randy Ollenberger on our morning call this morning, and he's our oil and gas analyst. And he said that, kind of the longer term picture here is, with oil is primarily in terms of the opportunity for future growth for Canadian exports of heavy crude oil down to the U.S. if all of a sudden Venezuela comes back into the market with their heavy oil product. But that's certainly nothing that's going to happen in the short term. I don't think any of our listeners would be surprised by that. But, longer term, we'll have to see how that kind of plays out. With regards to the markets, the Canadian market was going to finish down from its highs anyway, going into the new year. So still finishes off with a really strong rate of return around 20%. For a little while, we were trending around a 23 or 24% rate of return on the TSX. And then the S&P 500, in US dollar terms, finished at around 16%. So yeah, markets are up today, which is good. Gold price is off their high, but still doing really well. And then, Bitcoin again kind of finished low, but even Bitcoin kind of surprised us by kind of rallying a little bit to the upside. So kind of we'll call it a healthy start to the new year.
What about bond markets? What's the forecast for Canadian and U.S. markets?
Yeah, I'm glad you asked. And, we've kind of talked about the bond market a couple times, and, the bond market can seem really boring. Most people get excited talking about stocks because in general, we're going to see better long-term rates of return off of equities as compared to fixed income. But I like talking about the bond market and over my time in this business, which is coming up on almost 30 years, is that I've become more interested in looking at the bond market because it does give us a little bit of a leading indicator in terms of what, economic conditions are setting up for. And so how we assess the bond market is we look at how our observations of the bond market evolve and how they're changing. So we're trying to really kind of see what's either getting better or what's deteriorating in the bond market. And so, the first thing we look at is probably the easiest is just the steepness of the yield curve. So what's the difference between what an investor would get for investing for 1 year versus what they would get for investing for 5 years or 10 years or 20 years. So that's one part. And then the second part that we look at is we look at different types of credit. And so, the primary pieces of credit that we look at the most is we look at the risk-free credit, which is generally government bonds. So that would be Government of Canada bonds or U.S. government bonds, treasuries, versus corporate credit. And so this would be where businesses are borrowing money, probably from banks. And so we look at the spread, the difference between what a business has to borrow versus what governments have to borrow. What we would see is, if we look at the U.S. first, is that largely our forecasts from, say, 30 or 60 days ago are kind of playing out how we expect. We're looking at very, very stable bond market. We're seeing, longer term rates, 5-year and 10-year rates rising, but very modestly, 10 to 15 basis points. Short-term rates have fallen about 12 to 15 basis points. So that supports our thesis that the U.S. is is likely in store to cut interest rates next year. And right now, our position is 3 rate cuts. When we look at the Canadian bond market, currently our forecast is that Bank of Canada, we're not expecting any cuts anytime soon, is that we've actually seen 5-year bond rates fall a little bit. So that's unexpected. And so what that would suggest is that there's some weakening in the Canadian economy expected. Now that's probably not too much of a surprise, even though there was lots of things to be excited about with the Canadian economy at the end of the year. But what that may suggest is that the bond market is pricing in that the Bank of Canada might change their current stance. And perhaps we might be looking at a rate cut later in the year. And as I said, right now, that wasn't something that was expected. So overall, credit conditions remain good. For investors, investors would always want to make more money investing in bonds. But primarily right now, the opportunity is clipping those coupons, which, on longer dated bonds is, somewhere between 3 and 4%, in that 5-year range, which was probably where most investors are when they're buying fixed income products.
When people are doing their financial planning, is there something investors should do at the beginning of the year that is different that they might do over the course of the rest of the year? Is there something seasonal or fiscal that we should be looking at?
Yeah, I would say there's actually a really big checklist, and everybody's checklist is going to be a little bit different. But just, early indications for, our team here in the first week is we had, lots of our clients wanting to make their TFSA contributions. So, get that money tax sheltered as soon as they can. So we get, for most people, that's $7,000 a year. If you're legal age, depending which province in Canada you're in, you get $7,000 kind of fresh off the year. First home savings accounts. So a relatively new investment, been around since the fall of 2023. So for those eligible to open a first home savings account, they get some new room, another $8,000 worth of room to put into their first home savings account. Most people would be familiar with the situation with regards to their registered savings plans. So looking at your notice of assessment to determine how much money you can put into your RRSP, new calendar year means new room, even though you can still make a contribution for last year for the first 60 days of this year. Registered education savings plan. So again, for people that have eligible dependents and they are putting away money for post-secondary education, is that in most cases, that's $2,500 per eligible beneficiary. That again, more room. And then another one that I find is really, really important that I'm a big advocate for is that if you have a mortgage, depending on your lending institution, is that most lending institutions allow you to do lump sum payments against your mortgage and perhaps even increase your payments if your goal is to pay off your mortgage sooner. In most cases, that's based on the calendar year. So as soon as we get to January 1, is that you can usually make some form of a lump sum contribution based on what the original amount of your mortgage was, or increase your payments. And both of those are very effective at enabling you to pay off your mortgage sooner, which I always think is a great idea if you happen to have a mortgage. So lots of lots of things on that checklist, putting money aside, and I think for everybody's got kind of different priorities. So I wouldn't say that any of those are any more important than the other. Really depends on what your financial plan is, and that's where you want to be speaking to your investment advisor, your financial planner, and prioritizing the items that are part of your wealth plan.
And of course, for wealth management and to start your investment journey, you can find Patrick's contact info at www.patrickmleonard.com. You can also find past episodes of the Wealth Roundup podcast. And there you go. That is the Wealth Roundup for the week of January 7th, 2026. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick.
Have a great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.